Welcome to Wealth Management Mixtape, a go-anywhere show about life, finance, and investing. Join Jake Heisler and Tim Miller as they talk about what they're reading, writing, and experiencing. Jake Heisler and Tim Miller work for Quaker Wealth Management. All opinions expressed by Jake and Tim or any podcast guests are solely their own opinions and do not reflect the opinion of Quaker Wealth Management. This podcast is for informational purposes only and should not be relied upon for investment or financial planning decisions. Clients of Quaker Wealth Management may maintain positions in the securities discussed in this podcast.
All right, you want to talk about the Phillies first? Let's talk about the Phillies.
Yeah, I think it was 2 weeks ago. Maybe they had started that winning streak that they're now currently on, but what did they win? 9 in a row and 11 of their last 13.
Is it the Joe Girardi effect? Is he that influential? Is it that miserable of a clubhouse that he created that they're just having? It looks like they're having fun now playing.
I have to ask, does part of you feel bad for Joe Girardi?
No.
Not at all?
Do you feel bad? Why would you feel bad?
I just, whether it's Joe Girardi or anybody else, you never want to see. He was a good guy, right? I don't know what went on behind the scenes in the clubhouse, but it wasn't like a Gabe Kapler situation where he wasn't really popular within the city. Like Joe always embraced the city and good guy. He seemed to be a good manager, and it's unfortunate that they win as many games. I mean, obviously I don't care because I'm a Phillies fan, but still feel somewhat bad that he didn't succeed.
Yeah, he was more like Gabe Kapler than you'd probably think. He's very analytical, and he would take guys out that there's really no feel there, which is odd because he won the World Series, but it was so long ago that he won the World Series. People forget how long ago that was. So it was time to move on. They needed to shake it up somehow, and that's the easy way to do it in sports is fire a coach.
I think the one thing I will say, like he can't control Rhys Hoskins finally putting it together and Kyle Schwarber starting to hit, and obviously Bryce Harper's always kind of steady in the lineup, but I don't think he can control some of those effects. But what he can control is that I think before he was fired, the Phillies had the most different. I think they had like 37 different lineups to start the year, and that was the most in the MLB. So.
Yeah, it's challenging with this with the defensive setup. That's the challenge. And Bryce Harper has to be DHing now because of his shoulder, I guess, or whatever it is, elbow. So you're stuck, and you got guys like Castellanos, and I can't really field that well, and so it's a pretty miserable defensive team. But they're winning, which is fun. It's actually they seem like they're having fun, and then it's the crowds are back, which is always helpful too. So who knows? Of course, they're like just above 500 again. It's not like they're, and unfortunately, Atlanta was winning this entire time.
So Atlanta's 14-0 since they've started their streak.
I mean, come on.
Imagine going 11-2 and not picking up one game on the team in front of you. That's what you've actually lost ground because they're 14.
Yeah, but imagine if you only won 7 of those games or 6 of those games. You had a pretty decent outing, and now you're way behind. So at least you're kind of keeping pace, which is good. I think they're a pretty good team. They just they need some bullpen help. They'll be okay.
Yeah, I
don't know if they're a playoff team. I made a
you
call.
Don't think so?
I said, I don't know because the probably not because they have to compete against within our division and then the rest of the National League. I had them over under at 85 games this year, and I picked the under for them. I don't know what Vegas had or anything like that, but anyway.
Interesting. Should we move to the markets?
Speaking of against all odds, the market just closed. I've always wondered who, there's an opening bell and closing bell, and you have your special guest who rings it, or team or company or whatever. Like, who gets the short end of the stick in a closing bell of like a market like today, where it's down almost 800 points, the Dow. Like everyone's like, just get off the stage. No one cares that you're ringing a bell.
And they have to
But they're always
smile
so
and clap.
excited.
And, yeah.
Yeah, they're always so excited because it's like a once in a lifetime opportunity. And then the market's like, no one's watching it, or they're wishing it's over. You know what I mean?
I was just telling somebody I'm so happy that the markets are closed on Monday. Just a day off is nice.
We'll see what happens tomorrow. Everything's so oversold that it's like I guess we already had a little relief rally in there, but it'll be interesting to see what happens tomorrow. And if you look at like Tom DeMark's symbols, I don't even know if we're allowed to talk about it. Probably not. I'm not going to mention it then. Anyway, his symbols are showing some exhaustion on the selling side, but it doesn't mean it has to be that way. So it'll be interesting to see here moving forward. We talked about it last week. There's just not enough good news to turn the market around, and clearly the sellers haven't stopped selling. And the Fed, has increased rates on Wednesday or this past week by 75 basis points. And their last meeting, they said they weren't even thinking about 75 basis points. So what's changed?
It had to be the report on Friday, right? You think it changed that close to a meeting that they saw that data come out on Friday, and here we are on Wednesday, and they moved it from what was perceived as a 50 basis point move to 75.
Yeah. I think the thought is that this inflation continues to stay high for the next handful of months or few months. And then once it starts turning over in a material way, that it turns over pretty quickly. It falls pretty quickly. So I think my guess is that they took this opportunity to say that inflation came in pretty hot, and they'll take the opportunity to raise it 75 or 0.75%. They said their target was 3.4%, and then it's maybe these are efficient markets. I don't know, but the 2-year Treasury yield, which is really we look at it as a 1-year predictor of what the Fed funds rate will be a year from now, is what was at 3.4% also. So that's a pretty efficient market, I would say. It just front run though the entire time, so that's a little odd. But this is just, we talked about in the last episode that these pendulum swings are so big. Like, this is a big move, the largest hike in 3 decades. I mean, it's big.
Yeah, I mean, what is your take on the move? Do you think that it was justified giving the data, or it was reactionary? And I mean, they just last meeting they said that they weren't even considering 75. We saw the reaction yesterday, where the market is positive and we see some relief in the market, and then we lose all of that and some today. So what do you think that's telling us about the markets?
That all news is bad news. We were talking about in the office yesterday that I think if they came in at 50 basis points, the market would have dropped immediately, meaning they're not doing enough. If it was at 1%, it was they were doing too much. I think they hit the nail on the head with 75, and that was the best possible market reaction we could have had, which actually wasn't that big in the grand scheme of things. It was already up, 1% for the day, and then it ended up whatever it was, 1.2% or something. So it wasn't a big move. I think today was the reaction, like, this will have might have minimal impact, or they have to get super aggressive, which pulls us into a recession. So I think the Fed's using what they have at their disposal, which is affecting the Fed funds rate, and on top of that, they're cutting supply. They're reducing the balance sheet. It's a tightening environment. Like, this is it's just tough to have markets rally in a tightening environment like this. And I think we're seeing things that we haven't really seen. Like, there's no playbook for this. Just this economic environment, and so uncertainty always breeds volatility, and volatility usually happens on the downside in environments like this.
Yeah, I don't think there's any playbook for an economic shutdown, complete shutdown, which there was 2 years ago. And now we're feeling the effects 2 years later of excess liquidity in the market and, quantitative easing for maybe what was perceived as too long. And now we're trying to get out of that and catch up a little bit, it feels like. And that's what, it felt like to me was, I thought 75 was the right thing to do after looking at the data on Friday. But you're right. It's tough for the market in a tightening environment. You hit the nail on the head when you said all news is bad news right now.
I think when you go when Powell goes home at night, he just closes his door so no one can hear him. It's like every little minute detail that he said in his press conference was broken up and analyzed and
anything he says they're trying to use against him. I would not want to be him. He has to be so careful of what he says.
Yeah.
Or else they're just picking him apart. So
yep.
Would not want that job.
We're talking about volatility. We talk about it often, but like this is just this is normal for the markets. I think you had sent over to me the tweet from Morgan Housel, which is like, if you're a long-term investor, you have 100% chance of being part of a large bear market and economic contraction. 100%. But every time it happens, it's like it's this kind of freak out, and
like it's never happened before,
right? But the way we talk about it sometimes in relation to individual investors is, look, volatility is the ticket to the show. There's a reason that there's outsized returns in the S&P or any other stock market for that matter, or index for that matter. And the price of admission is volatility. Right, you can't have one without the other. We'll put a little graph up here or chart up here in a second, but I posted it a while back, which was, from 10 years ago, the S&P 500 kind of, jumping around to where it is today. I think it was up 200 in the last 10 years, 250 or 80%. It was a big number, right? And then I drew a straight line between the start to the finish, and it'd be great if everything was just the straight line, right? Straight up. And you didn't have to worry about the ups and downs. But the reality is you can't have that straight line return without the peaks and cliffs and valleys and that sort of thing. So volatility is just part of the show, part of the ride.
I think something that's good to remind folks is, like, right now we're getting a lot of questions around what's going to help turn this market positive. Like where is the relief going to come into the market? And I think in a lot of these situations, it's tough to tell whether that's inflation rolling over faster than anticipated, or the Federal Reserve not having to hike rates as much as we initially thought. Like maybe Russia, Ukraine, something happens on a positive note. You never really know where those positives for the market are going to come in. And then it took me back to just 2 years ago in March of 2020, where we had never seen something. It was unprecedented how, this economy was essentially shut down in the matter of weeks. And you're thinking, okay, where do we go from here? Like, what's the next step to turn this market around and reopen the economy? And a lot of folks, there was like a very nervous feeling, which is natural in times of market drawdowns. But then you start to link, you take a step back and you look at it after 2 years and you think, yeah, the market was down. What was it, down 30 something percent in March of 2020? And correct me if I'm wrong, but the market was up for the year.
Yeah, by a good margin. Yeah, of course.
By a good margin. So not saying that we're going to repeat that here in 2022, but it's always a good reminder to folks who get a little bit more nervous during times of market uncertainty that, the ebbs and flows of the market are part of being invested, and being invested is key.
Right. And having that perspective is key. So to just knowing that these things happen, that again, 100% of the time you're gonna experience a bear market if you're a long-term investor. and then not getting too high or too low either way. It's a good point. And we'll put a chart up here, and we went back to 1950, so the last 72 years, and then in that time frame, 3 out of every 4 years, the market is up. The S&P 500 is up, and 1 out of 4 times, then the market's down. But I think it would surprise people to know that the average up year, so 3 out of every 4 years, the average performance is 17%. And then 1 out of 4 years, the average performance is minus 13%. So the average up year is higher than the average down year. And then I mentioned, I think I posted it on LinkedIn, but it was, if the market were a casino, it would be out of business in like 2-3 years. And they'd be giving away substantially more winnings or more money than they'd be taking in. And that's the entire point. Like with investing, having patience and then perspective, you're rewarded in essence just by staying at the table, if we're using the casino analogy. Just by hanging in there, you're rewarded. There's not many other places that or opportunities like that. And we just happen to be in the middle of one of the best economies of all time, meaning if we're ranking them globally, the U.S. economy. So having access to this market is better than any other market over time. And I think we take it for granted. Right, 2020 started down, up over 15% when it was said and done. 2021, well, we know how that went. That was almost 26, 27% when all was said and done. And now we're down over 20%. We're formally, officially in a bear market. But these things they have to shake things up a little bit. And that's why you get outsized returns with the S&P 500 over time. It's because of the volatility. It has to happen that way. Otherwise, those returns wouldn't be as high. It just wouldn't happen.
And what do you always say? This bear market is as bad as the last bear market that you forgot about?
Right. Yeah. This is as bad as the last time you forgot about it. Everyone remembers COVID because there's a recency bias. So remember that scenario, and it was coupled with what you mentioned, which is the whole economic shutdown. It was unprecedented. Everyone remembers the financial crisis, right? Because it was so drawn out, and gigantic names went out of business. Home prices fell considerably. People remember the dot-com bubble because it was the first kind of run-up of the internet, and then 9/11 happened also in this similar time frame. People forget the in-between times. 2018, 2011, there was a big pullback. And so those are the times that it's just part of a normal market environment that most people forget about. So yeah, this is as bad as the last one you forgot about. And at some point in the future, I'm guessing actually, at some point in the future, people forget about this too. There's no event that's coinciding with this that implants a memory in your head, like COVID or the financial crisis, that sort of thing. And maybe there will be an event. I don't know. But as of now, I suspect this will be one of those that we forget eventually.
And I think just a good reminder is looking at the performance 6 months prior, during a recession, and then the 1, 3, 5, and 10-year numbers post-recession. And if you just look at what it means to be a long-term investor, if we're looking at the 5 and 10-year numbers, they're up considerably over that time frame. So although what we try to, I guess, the messaging we try to portray to clients is, even if you're, like we were talking about this earlier, even if you're 70 years old, hypothetically, your time horizon is still pretty long, right?
Yeah.
Given to the end of your life. So unless you're drawing down your assets in the next 2 or 3 years, which most folks in retirement are not, they're drawing it down over their lifetime. They have considerable time to wait out this volatility and see the market recover as what we say it always does.
Yeah. And the fear is always going to be amplified during an environment like this, especially for folks that are retired. We talked about this last week, because they don't have income to replenish those assets. It becomes scarier. And again, it gets back to perspective that, right, if you look at the 10-year number after the recessions, and this would be our, let's see, 5, 6, I don't know, 13th or something like that. that the average is, 250+% over the 10-year period. It's really positive returns. Anyway, it's important as a reminder that things over time go up, and it's easy to place blame. And we hear it quite often that we want to put blame on, Trump or Biden or whatever other policy it is, and we're just giving too much credit to the influence that the president or some of the other positions hold. I would give more influence to Powell, the Fed chairman, right? He's got much more of an influence over the to market performance and economic outcomes. And so it's remember that through all these presidential terms and through all these midterm elections, which we have one coming up, the average return over 10 years is high. It's in your favor. And so you don't want to be trying to jump out of this environment and jump back in at a certain point. We also looked at there was the 60-40 portfolio too, which is more in line with how most people are invested. There's some balance between stocks and bonds. And the worst 20-year periods for the 60-40 portfolio. And the worst one it ended in 1948, so it was started back in 1928, right? Great Depression, and you still doubled your portfolio value in that time frame, right? And then more recently, if you the 20-year period that ended in 2019 and the 20-year period that ended in 2018, those were on record two of the worst 20-year time frames ever, right? Dot-com bubble, financial crisis, COVID, et cetera. Actually, not COVID yet. And you're still looking at about 6% per year in investment returns. That's the worst 20-year period. So again, perspective. If most advisors are planning on behalf of their clients for retirement withdrawals of 3 to 5%, or whatever the number is, give or take, then it's good to have a reminder that on average, in the worst environment, those returns would have covered those distributions and then some. There's actually more information coming out now from a planning perspective on that a 60-40 portfolio has a much better chance at a 4% withdrawal rate, has a much better chance of actually growing in size in retirement, meaning you end up with more money than you started with at the end of your life. And that's counterintuitive again to folks that are retiring, but that's the reality of what it is.
Yeah, I think I would say it again. Perspective is key when entering retirement, and understanding these ebbs and flows of the market is crucial to not overreact during times where it's easy to be emotional.
I had this philosophy that I've always thought of, and it pertains to this. It pertains to everything else. And from folks that you talk to, and I know it from folks that I talk to, but I feel like us human beings have this like complaining meter or anxiety meter, right? Whatever you want to call it, where like you have a baseline, I have a baseline. Everybody has different baselines, right? And so if it's not the market's doing really well, that person that has a high anxiety level traditionally will find something else to be worried about. It might not be anything with the market, something else in their life. And so if anxiety goes down on the market side, my guess is they're building anxiety somewhere else. They're going back to their baseline somehow. And so now it just happens to be that the market is a contributing factor to their anxiety levels. And so they're probably actually less anxious in other places. They're probably, you know what I mean? So it's I've always thought that's a thing. I can't prove it. But I've always thought there's kind of this baseline anxiety levels, and it just varies by person. But we know
you came up with this yourself, or you read this somewhere?
No. This is my own personal, or maybe I read it somewhere and stole it, but I think it's my own personal idea.
Anxiety cycles.
Not even a cycle, but just a level. Like, let's say that anxiety, the market recovers tomorrow, right? And those folks that are really anxious about the market, it's almost like you've dumped the anxiety glass out, right? The anxiety level out. So it's low. So they'll find a reason to fill it back up again somewhere else in their life, right? They'll be anxious about something else, politics or their job or a family relationship or marriage or whatever it is. That they'll always find a reason to get it back up to baseline. I don't know.
It's interesting.
I don't know if you can alter that as you get older or not, but that's my philosophy.
I was just about to ask. We talked about like, do we dig more into our biases as we get older? But do we get more anxious because as you get older, you expand responsibilities just naturally? You have, you have kids, you have grandkids, you have work. Your work role expands. There's just naturally more to be anxious about.
Yeah, but I'd be willing to bet that that person, even with all the additional stressors around you, that you still kind of maintain a base level throughout your life, that you're still kind of, that would be my guess. Again, I don't know for sure. And crypto is getting crushed along with every other risk asset, aside from energy stocks.
Where do you go right now in crypto? Is it Bitcoin and forget about everything else?
You never know for sure, but there's usually in times like this, just like in the stock market, that if the market's dropping, you'd rather be in quality. I think it probably rings true for crypto too. And there's these periods of time, we go backwards in crypto, and it's much shorter history, but that where Bitcoin dominance in the market increases over a period of time. And it usually starts when the crypto market starts to fall. So there's this flight to quality, right? And there'll be a point in the future where it makes sense to convert back to these alternative coins or tokens. But right now, personally speaking, I'm mostly in Bitcoin. And that's no fun.
Yeah.
I'm a long-term holder though. So,
yeah.
Or hodler or whatever you want to call it these days.
Should we go to Ikigai?
Ikigai, yeah.
Why don't you tell us about that since you found it?
Well, it's a Japanese concept, so I think it translates to your reason for being. We'll put the illustration up on the screen here, but for us, because we're always doing financial planning and talking about how you should live the life you want to live today, and or plan for the life you want to live in retirement, or a combination thereof. But what gets lost in that is how you actually do that, because while we're working, and we have to earn an income to support ourselves and our kids and family and our hobbies and that sort of thing, that there's a way of doing that supports a few different concepts. And one is, look, you could do what you love, right? But then it might not earn you any income, right? You might be conscientious about what the world needs, right? But if you only do that, maybe it doesn't help you earn a living. You can do what you can be paid for, right? So you could only focus on the highest potential salary, and that helps you out from a material standpoint and lifestyle standpoint, but it might drive you crazy in other ways. And then you could do what you're good at. And then if you get all of those four things, what you love, what the world needs, what you can be paid for, and what you're good at, and they all align, that's called Ikigai, right? Again, it's spelled Ikigai. I'm worried about people think we're saying here, but so it was interesting to me, because we're always talking about planning, and maybe there's a thing that financial advisors can do a little better, which is be cognizant of not only the financial side of things, but how somebody is growing their wealth in the life they want to grow it. That's kind of why I thought it was interesting. And I think for me, at least, this is an open door to have a more meaningful conversation with people. So that's
Don't
why.
you think this will help? Like, this conversation will just help facilitate and be used as a guide for people to create goals, or for us as advisors to better understand goals of clients, and kind of the why, like their clients why, I guess you could say, is
Yeah.
why, like what drives you to do what you do. And like right now we're seeing this phenomenon where more and more retired clients are going back and working part-time, not always in the same industry that they worked for 35 years, but sometimes it's going back and doing something that they like to do with some of the hard skills that they developed over their working career. So
Yeah.
I think it's interesting because it kind of brings back, a piece of always is what you can be paid for. You're always going to have to use a piece of that if you want to go back and work. Not always, I guess you could say. Sometimes
Be
you don't
volunteer
have
work.
to.
Yeah.
Could be volunteer work. But
Yeah.
in most cases, you're going to take some hard skill that you've developed over your working career, and you're going to combine that with something that you enjoy doing. Maybe it's something that is for a good cause, or allows you to focus on the day to day, relatively low stress levels. Um, Maybe it's just convenience at that point, and keeping active, because we know that part of retirement is kind of defining your goals. We always say that in the office, let's define your goals. And maybe defining their goals is not just sitting around the house for 8 hours a day without anything to do. It's just staying active and remaining healthy once you get a little bit older. So
Yeah, and
I
maybe
think
it's helpful to have. Sorry to cut you off. Maybe it's
no,
helpful to have almost like a worksheet that says like, "Hey, what am I good at, and what do I enjoy doing, and what does the world need, or and if there's if it's not retirement, what can I be paid for, and doing all these things." There was a series of questions that I really liked too, which was, um, specifically for retired clients, are you doing an activity that you love? Are you good at it? And then there's follow-up questions. Does the activity allow you to start small and improve over time? Right? Does the activity allow you to release yourself? Don't know what that means. Does the activity pursue harmony and sustainability? Important for some, probably not others. But does the activity allow you to enjoy the little things? And does the activity allow you to focus on the here and now? So it's on a kind of deeper level. It's referring to the emotional circumstances, that people feel their lives are valuable, that they're moving, to your point, towards their goals. But for me, I'll give you a personal example. I think I didn't realize this until probably, I don't know, 2 years ago, that I really enjoy writing. I didn't enjoy it in school. In fact, I probably was closer to the hate side of things. And, but I really enjoy it now. And as I do it, I try to, write something usually once a week. And as I do it, whether it's good or not, I don't know, but I enjoy it, and I'm getting better, I think, which is kind of cool. So I could see something expanding, at least in my life, around that, when I don't have 3 kids, tugging at my shirt, sort of thing.
Yeah, I think it's more time. I mean, just from being around you and seeing your work over the last, I've been here 2 years now. It's definitely, progressed over the last 2 years, and I can see it just starting to build more and more and more, and you do it more frequently, and the more frequent that you do it, you start to like it and becomes better. And, now you're starting to venture into topics, all different types of topics, which is really interesting. So not only just financial planning, but things that interest you. I think I'll be there one day. I don't quite as enjoy it as much as you do, but it is fun to write something that you're passionate about.
Yeah.
And
Well, everyone, hopefully we have it we have a blog site now. We should mention that on our website, wealthmgtmixtape.com. And there's a blog post on there called Amber Heard Amber Heard will never love you. That was like, so that's obviously not financial related, but that whole thing was ridiculous. And so it just made me think about celebrity and why people worship celebrities in the way they do. And I think it's silly, but I kind of get why people do it. It's the same thing as the car paradox, which is, you envision yourself driving that car, Nobody else cares that you're driving the car. And then celebrities is kind of just a reflection of that you wish you had all that attention. And so you give it. But the reality is most people don't really care.
Yeah.
But anyway.
Should we move to
Johnny
fun
Depp?
stuff?
Johnny Depp? No. You know what? I we didn't talk about this in our pre our meeting before this, but did you click that link, the Jetsons link?
I did.
Did you ever watch that?
I have maybe once or
Are
twice.
you familiar with it? I'm too old.
I'm familiar with it. Never really watched it, but I did look at it, and it was cool to see. I guess you saw this, all of the technologies that they used throughout the show. I guess it almost reminded me of The Simpsons. You see all like the things with The Simpsons that they've predicted.
Yeah.
And it kind of reminded me of that.
So this is the Jetsons we're talking about, by the way, which is like George Jetson. Oh man, I forget the names of everybody now. Wife Judy.
It says it aired in 1962.
Yeah, so I thought it was. I watched it in the 80s, and so they re-aired it in the 80s. But it was written in 1962. It's a technology that they wrote about were pretty cool actually. There was teleconferencing, right, which wasn't a thing back then. They had flat screen TVs. They had tablets. They had smartwatches. They had a pill you could swallow with a camera on it, which exists today. 3D printed food, which is happening now.
Drones.
Like that's what a cool job to have. You're a cartoon guy with just a creative. You're trying to create storylines and envision a future. And a lot of the stuff you got right. And there's other stuff they got really wrong, like you'd be living in the sky. But I think it was set in 2062 because it was 100 years in the future from when they were writing it.
You think living in the sky has a chance by 2062? Maybe if Elon has anything to do with it, we will be, right?
We'll live on Mars if he has anything to do with it. Yeah. I don't know. I think that's an untapped space. I know they talk about vertical farming, right? So you farm up as opposed to out, so you could use less space and farm vertically.
It's interesting.
Yes, that could be something. I think the idea was that you couldn't live on the ground anymore because of like pollution or something. And so hopefully we're not living in the sky in 1960 or 2062.
Seems a lot, way too close to have all that happen.
Well, it's 40 years. 40 years? 40 years away.
Yeah.
So that's a lot will change in the next 40 years. It's that we talked about last week, Ray Kurzweil and the acceleration of technology. Just imagine where we were 40 years. Well, you can't because you weren't alive then, and I was only 3. But 40 years ago was 1982, right? Pre-internet, pre all this stuff, So it'll be crazy to see where we are in 40 years from now, because it'll accelerate much faster than it did from 82 to now.
Yeah, it's accelerating at a rapid pace. Is it time for? Is there anything else you want to add? Is Pop Chart?
Pop Chart. Let's do it.
Yeah. I think
This is your pick. Today.
This was kind of a random pick. So
I feel bad because I picked out a disappointing beer for you last time.
What was it again? We don't even remember the name of the beer.
Yeah, it was the apricot one with. I can't remember either. But I liked it. I think I enjoy that type of beer for like if I'm sitting on the beach, which I plan on doing this coming weekend, next weekend. Sorry, not this one, but the following one. So I might look for that beer.
Let me introduce it. It is the Founders All Day Vacay, the Session Wheat Ale.
Now, Founders has the All Day IPA. It's a favorite. But I don't think I've ever seen this, the all day. Now, wheat beers usually have low alcohol. So the idea of an all day beer, I think it's low alcohol. You can drink it all day, right? Not that it's advised in any way by Wealth Management Mixtape.
Never put that together, but makes sense.
Yeah. All right. Well, you get to give the first score. I'm going to taste it now.
Got to remember what the scores were. We really got to make that scorecard with all of the beers.
Why don't we plan on? We'll put it up here right now. We'll put it in the corner somewhere. What our previous scores were, and then we can print it out next time and have it in front of us. This is a Tim beer written all over it.
Yeah, doesn't have much taste.
No, it does. It's good. It's good. I think it has actually a decent taste for a low alcohol beer. I'm always a fan of wheat ales, especially in the summer. It's good to have by the pool.
Yeah, I mean, I like it. It's not anything like special, but I like it.
We have to say nicer things because we haven't had any beer sent to us as a result of this.
I should say
that's the only reason we're doing this.
Light beer I've ever had. Founders, if you're listening, please send us beer.
Yeah, why don't you? Yeah, they got to start caring about the little guy.
I don't know. Maybe I think my score would be a 7.3.
Okay, that's good.
It's good.
That's good. I'll give it a 7.5. We're right in the same ballpark. But this is something that I have in my fridge during the summer. And wheat ale doesn't like an IPA. You got to drink it early, like it's closest to the can date or bottle date. Fresher the better. With wheat ale, you can let it hang out. It doesn't matter. You can kind of hang in there for the summer, or just keep it in the fridge, and
So this is what, like a sit by the pool, sit on the beach type beer for you, or
it's just like
not so much?
Standing in the corner of the pool at 6 p.m. when the sun's going down, the corner of our pool gets this sun. In fact, when I moved in there, I don't know, 3 or 4 years ago now, the previous owner said, "This is the spot that you want to commandeer at the end of the day. Is this corner right here? Still get sun at the end of the day. Grab a beer and in my world, wear headphones so I don't hear all the screaming going on." But
anyway. You'll be past it soon enough. Maybe another couple of years. You can take the headphones out.
You haven't offered Tim to ever babysit, and this is maybe something you should consider. If you and Alex are ever considering kids, come over to our house first. And then
would that completely turn us off from the idea, or push us off 10 years?
I'm not saying that, but yeah, it just to get a sense of what it's like. I would suggest for us, you come over around 6:30. I don't know, 5. Let's say 5:30. Dinner's starting for everybody, so we got a sneak dinner in for everybody, and it's like the Golden Corral at our house. You ever been to a Golden Corral?
I've never been there.
Neither have I, but it's the buffet. It's like there's a series of food that's constantly being brought out because you never know that they're going to eat, right? So I might, for Abby, for example, is the 4-year-old, I'll make her a pizza or something or whatever. We'll cut up fruit, and then she says, "I don't want this," and then you can't say, "Well, yeah, you do, eat it," because they're supposed to say, "No, I'm not going to eat it," and you're like, "Well, you have to eat it. It's what I made. I'm not going to eat it." But as a parent, she's got to eat something. So you move on to the next thing. How about something else that's sort of healthy? Why don't we get something like, I don't know, who knows? It ends up being like a bagel and cream cheese, or like a piece of toast with peanut butter on it. You get yourself whittled down to like, you convince yourself that it's somehow nutritious in some way. It's really not. So luckily our 1.5-year-old twins eat a decent diet with like vegetables and stuff. But man, so did Abby when she was young, and not anymore.
She grew out of it.
Yeah, she grew
out of the vegetable stage.
Yeah, so we got to get her back in there somehow.
She'll probably come back in another 10 years?
Hopefully. All right.
I think we're
Anything else we want to talk about, or are we going to wrap it?
No, I think we got a couple of topics ready for next week. 2 weeks.
Yeah, next episode. I think we should talk about the reverse mortgage concept in the next episode. Super important, I think, wealth management tool that is underutilized for a variety of reasons. So we'll touch on it next week. Our next
And we
stop.
have our next beer already picked out. Was it, how do you say it? Lagunitas, right? It's the,
Lagunitas, yeah.
what was it called? Like the Ultra IPA or something? Super IPA?
Super something where it's really hoppy, so you'll
I'll hate it. We'll see.
Or we'll love it.
Tune in in 2 weeks to
Lagunitas.
see what I rate it.
All right.